You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Let's jump right into it. Last week, we looked at Amazon earnings. We had all the FANG stocks reporting last week, depending on what you actually think is a FANG stock. But the big dogs reported, Amazon, Google. The markets in general were a little bit all over the place, down, then up, and then back down again, and then back up again. Big moves, big swings on a point basis so far this last couple of weeks in the Dow and the S&P 500 index. Now, there's been some woes, and we talked about a little bit about this on the Disney Iron Condor that we looked at a couple of weeks ago. And on that Disney Iron Condor, we talk about the coronavirus and what had happened to Disney. Got beat up a little bit because they had to close down a couple of their parks in China. And because of those wild swings, our Disney Iron Condor did not work out as well. So we talked a little bit about what we would do to try to offset some of those wild swings in Disney. And then last week we looked at Amazon and we looked at a butterfly, and we had a very limited risk butterfly that we put on that was way out of the money. And guess what? Amazon went way beyond that way out of the money butterfly that we traded. We had a 60-point wide landing space that it could land in, and Amazon ended up going up $150 the next day after earnings. So it was very good that we did a butterfly and we didn't do a skip strike butterfly, which would have added additional risk to the trade. So I'm just kind of talking about the process and thinking about when we're looking at these trades on Options Playbook Radio, they're not meant to be recommendations. We're only doing these type of trades because we're trying to learn and do them based off of the pricing of the option contracts, more so than our forecast on the underlying. And so let's go back and rehash the last two trades that we looked at. In Disney, the reason why we were doing the Iron Condor is that Disney was very volatile and they were going to be announcing earnings. So going into earnings, we were thinking, well, let's do an Iron Condor with the expiration before earnings, because we're kind of hoping that the volatility dies and time decay works for us, and then earnings get announced and people go back to their normal trading. That was the concept. So we were doing it more so because of the scenario on Disney. Once again, in Options Playbook Radio, that's what we're looking at, as opposed to our outlook on Disney. Now, on Amazon, part of the reason why we did a butterfly is that it was a real cheap way to get long Amazon if their earnings if their earnings turned out to be a good play. In other words, they beat on the top end on earnings. And so Amazon announced on a Thursday, and that meant that there were one-day option contracts. And that's when butterflies are interesting to me. You have an expensive underlying. You have 1 day for those option contracts to live. And then you toss in an earnings announcement, which jacks up implied volatility. So the one thing that we do know about an option contract is that if it's at expiration, it will not have any more time value in it. And butterflies are positive theta. They like time decay. They like implied volatility to come in. The problem with the butterfly is that it's got to be within your wings. And we went 60 points wide, but I guess that wasn't wide enough because Amazon really killed it as far as the earnings were concerned. Okay. So the scenarios were excellent learning scenarios as far as Option Playbook Radio is concerned. And I'm going to keep with that theme. We're going to look at a trade in the SPX this week. And here's what's basically happened is that, once again, the coronavirus has driven markets down. It looked like for a second that we were going to maybe go into a bear market in the overall market in the SPX and the Dow. We broke through some key levels to the downside, and now the market has bounced back. But guess what hasn't? We still have the VIX index trading at 15. Actually, it's right at 15 right now, and we're taping Options Playbook Radio on Thursday, February 6th. The markets are open, and they're rocking and rolling. The Dow and the SPX is up about 0.5%, so basically we'll call it flat on the day, if you will, but the volatility index is still up above 15, and before all of this volatility kicked in, the VIX index was pushing down towards the 12-13 level. So we're going to try to take advantage of selling some premium in the SPX. Now, one way that you could do that, because once again, it's Thursday, and we're looking at Friday expiration, so you have 1 day for some SPX options to live. They would trade all day today, and then all day Friday. That would be the weekly option in the S&P 500 index with the February 7th expiration. But I looked at it, and honestly, the butterfly was just a little bit too expensive. I looked at doing a 20-point wide butterfly, and you had to pay, I think it was about a 7.25 for it. So the trade would have been more interesting if we would have looked at it on Wednesday, but now that it's Thursday, I think I want to just go away from the trade, and I want to talk to you a little bit just about my process. So I was expecting the butterfly to be closer to $3 or $4, but it's trading up towards 7. And you look at the volatility of the option contracts with the 1 day remaining, and that volatility is around 13%. It's not bad, but it's not as high as the monthly volatility, which is up around 15%. That is not unheard of. So in general, if I'm looking at this trade, I still think volatility is a little bit high. And so what I would like to do is not do the butterfly, which gives you a little bit more upside, a little bit more bang for your buck, a better risk-reward profile, if you will. And let's go in and look at just selling a call spread. We're going to either sell a call spread or we're going to sell a put spread. You can decide on either action. I'm going to look at a call spread, and once again, I don't have any idea about direction, but we need 1 day for this call spread to stay out of the money. So the markets have seemed to slow down a little bit. The VIX still seems to be a little bit inflated, the volatility index and the S&P 500 index. We still have the nearer-term options trading around a 13 or 14% implied volatility. So how do we set up our short put spread? And it's going to be a 1 day spread in the S&P 500 index. And the way that I would do that is, first of all, I would look at the nearest term option contract, which is the February 7th expiration. They are the weekly options, so they trade all day on Friday, as opposed to the monthlies, which do not trade on Friday. They actually settle in the morning on Friday. So we're in the weeklies. We're going to look at the most at-the-money straddle to start with. So right now on my option chain, the S&P 500 index is at 3,341 and some change. So we're going to look at the 3,340 strike straddle. We can buy the call and we can buy the put, and that's trading for about $20. So $20 is the move that we really got to worry about on the open. So if we're doing this strategy, all we're really saying to ourselves is we do not want the market to open at least 1%. 20 points would be about 0.5% in the S&P 500 index. So we want to be able to trade this position, and if we can make it till tomorrow without a 20-point swing, the time decay factor is going to be big in this trade, and it should be profitable overall. So we're going to go at least 20% out of the money, and in this instance, we're looking at selling the $3,365 strike. Okay, so that would be 25 points out of the money. So we're going to err on the side of giving ourselves a little bit more play based off of what the expected move is, or what that long straddle is for this very short expiration. So we're giving ourselves a little bit of $5 buffer. We're going to sell the 365 strike call, and then we're going to buy the 370 strike call. So we're going to go 5 points wide. We can do this entire trade at a net credit to the account of 60 cents. All right. So we're 5 points wide. That means that the maximum that this spread can trade for is 5, but we're bringing in 60 cents on that trade. So our max loss here is $4.50 on the trade. Overall, this is a very quick trade, so you're really hoping that the markets stay flat as they are right now. That's where we want the markets to stay. We see that the VIX is still a little bit elevated. I kind of expect the VIX to come in before the end of the day. We're taking advantage of the fact that we're dealing in a 3,340-point underlying, which is the S&P 500 index. And, for example, the at-the-money options right now are trading for basically the call and put are about $10 each. So if you look at that and you think of this overall, that's a lot of time premium on at-the-money option contracts with only 1 day remaining. Why is it that high? It's because we got a very expensive underlying, and it's because we have a very high volatility index. We have the VIX trading at elevated levels. So we're hoping that the market being flat right now, that stays to be the trend. And if we can even make it overnight, we should be okay with this trade. In other words, we just need on the open for the market to be below 365, which is 25 points higher than where the market is currently trading. Well, it's 24 points if you want to split hairs. It's 24 points higher than where the market is trading. So our whole goal here is we can sell this entire 5-point wide short call spread and hope that the market is neutral to bearish on the open, and we'll do a 1 day trade looking to pull in about 60 cents on the trade. Now, if the market opens down, I'll probably let this thing ride all the way to expiration. If we can get a 10 to 15-point move to the downside on the open, well, then I'd probably stick around in it. But if it is flat on the open, I would be expecting to get out of this trade at about 25, 30 cents. I might wait around, but if it gets down and the market stays where it's at, right at the 3,340 level or 3,350 level, if it's in that range and it's opened up just a little bit, I'm going to look to get out of the trade. I want to protect myself against any loss. Now, obviously, on the open, if it were to surge, which a 20-point move on the open in the SPX is a big deal. It's a little bit more likely to happen maybe over a weekend when you have major news. But if it did have a 20-point surge to the upside in this instance, if it gets to 3,370, that's my long strike, that's my protection strike. That strike is trading right now for a dollar on the ask. If it gets to that level, I'm getting out. Just bail on the trade. Don't think about it. You want to be able to sell at the money premium because you're long that long call option, or the 3,370 strike, I'd be long, and that would be considered an at the money option. You're going to get some bang for your buck. So that's our outlook for it. We covered a lot in that little strategy, but let's talk just a little bit about the concept and everything that we were looking at today. So I started out by noticing that the volatility index is still fairly inflated, even though the market has kind of bounced back. When the market was down, the VIX was trading right around 18. The VIX is now around 15. When the market was making a big bull move, the VIX was down around 12. So we're right in the middle. Let's sell some premium. Let's hope that this volatility settles down, which has been the trend over the week, and we're going to try to take advantage of that trend, and we're going to be selling either a call spread if you want to be bearish to neutral, or you could sell a put spread. You could go 25 points out of the money on the other side and sell a put spread. We're looking at a call spread. So we started out by looking at the long butterfly. The butterfly was too expensive, so we decided let's just sell a call spread. We sold the February 7th expiration, 3,365 strike call, and we hedged it by buying the same expiration, 3,370 strike call. Right now, that market is trading at the midpoint for 60 cents, and that means that that's our max gain on the trade. And it is 5 points wide spread, so that's going to be our margin requirement. But we can use that 60 cents to help offset it. That means our total risk on this trade would be $4.40. Don't forget to add in commissions. And once again, as usual, we're just trying to learn on Options Playbook Radio. So let's play it out. We'll be able to see what happened with this trade at next week's call, and we'll cover that, and we'll look at a new strategy. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer on the program, please send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.